The chair now recognizes the ranking member of the subcommittee on capital markets, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
And I would ask that the ranking member of the full committee be able to give her 1 minute when she arrives,
Without
whether
objection.
that before or after the witness testimony. Sat here in some crypto hearings and other hearings where people say we need to have, we don't want to have regulation through enforcement. Your division does regulation through regulation. You should be praised. I hear in those hearings how we need clarity. You're working hard to provide that clarity. I read in Bloomberg that you're actually putting forth fewer regulations than your predecessor. So work harder. And we're told that the process is criticized. Almost everyone who criticizes the process simply doesn't want you to get to the destination. It's not the road. Your division has done two things I want to talk about. One is you've put on a level playing field investors in these private funds. In doing so, you've taken away the advantage that, say, CalPERS, the biggest, would have over, say, Wyoming. That is a very bad thing. California should always be advantaged, and fairness is whatever gives California an unfair advantage. But if I was from another state, I would say congratulations on that. And second, you've got the streamlined summary reports for those investing in mutual funds. I've used those myself. Thank you. So while I generally approve of what your division is doing, I do need, along with the chair of this subcommittee, to talk to you about the swing pricing rule. Now, swing pricing rule is focused on the idea that maybe if people think the ship has hit an iceberg, they'll want to get on lifeboats. We want to discourage them from getting on lifeboats. First, if people think the ship has hit an iceberg, imposing a fee on them to get on the lifeboats is going to make them really want to get on the lifeboats. But we have a system under swing pricing where if you're a very large investor and you don't need a mutual fund, you get on you have your own private lifeboat, no charge. That is to say, if you're a big investor, you don't need a mutual fund, you just create a mirror portfolio. If you're a institutional investor and you're in the CIT, you're not subject to this rule. That is collective investment trusts. So you get on a lifeboat for free. The only people who have to pay for the lifeboat are the people who are on the ship in second-class steerage. That is a bad way to deal with, it's simply unfair to say that if people want to sell their mutual funds at a time when they think they've got to sell, even if they're spooked, that you charge them a fee for doing so. There may be a role for this swing pricing rule in some very narrow, relatively illiquid funds, but when you look across the board, I join with the chairwoman in urging you to substantially modify or abandon this. You also have the hard stop is necessary to implement it. That disadvantages Californians, and you already know how I feel about that. It disadvantages everyone in the Pacific time zone, even those from lesser states in the Pacific time zone. And then your definition of illiquid assets, I think, could be a problem in a number of ways, not only for the markets, but also for those dealing with apartment loans. And the number one concern of my district is homelessness and the fact that rents are too damn high, and that's a matter of supply and demand. So 36 of our colleagues, including the vast majority of Democrats on this subcommittee, have written you on swing pricing. Keep doing a good job. Part of a good job is to stop doing that.
Recognizes the gentleman from California, Mr. Sherman, the ranking member of the Subcommittee on Capital Markets, for 5 minutes.
I share Mr. Hill's concern on these custody rules with regard to tangible assets. I think they were, the mindset that went into drafting them was crypto and perhaps other intangible assets. How you would apply custody rules to real estate and whether you would have to put the real estate into a different title, I frankly haven't looked at, but I think you've got a rule that's designed for crypto and perhaps other intangible assets. Now, looking at swing pricing, Chairwoman asked whether you would withdraw the rule, and you pointed out that's above your pay grade. But I hope I can count on you to go back to the commission, say you came to this subcommittee, and you saw a unified, bipartisan, and well-reasoned commitment to get you to withdraw the rule. Can I count on you to do that?
Certainly, sir. We will, as a staff, share all of the learnings we have from a session such as today, the letters that you and the chair have furnished us with, as well as the comment file with the commissioners.
Now, a number of things underpin that. Of course, it's not just this committee where it's bipartisan. You've got business-oriented groups and liberal groups, both on this. The SEC has permitted swing pricing. Mutual funds are very competitive. They've got every different combination I can think of. And yet none of them, and correct me if I'm wrong, has chosen to go with swing pricing, which means none of them thought that there was any pool of investors out there that wanted to be in a fund that had swing pricing. Do you know of any fund that has gone with swing pricing voluntarily?
Sir, you're correct that in this jurisdiction, none has. In other jurisdictions where there is different plumbing, if you will, it has been used by advisors.
This is a big enough country. It's we're talking about so many different mutual funds. You can invest in so many different combinations, and nobody has wanted that. I would point out that the Biden commission is absolutely dedicated to ending junk fees and surprise billing. When I put my money in a mutual fund, I buy it at net asset value. I complain a little bit that there's at least a management fee. And when I redeem, I expect to get net asset value. Now, my father, when he invested, there was a 5% load getting out. That was a really bad system. We haven't had that in any mutual fund I'm aware of. So it's a junk fee, it's a surprise fee, and it will have the effect of discouraging investment in mutual funds, which is the one thing we want people to do. We want the diversity. We want the investment in our economy. We don't want people investing in the number 6 on the roulette wheel, or worse yet, cryptocurrency. We don't want them picking one or two stocks. We want people to go to mutual funds. Am I correct that the large institutions and the wealthy can escape any swing pricing, either if they're banks investing in CITs, which are basically mutual funds but outside your jurisdiction, or if they're wealthy individuals just constructing their own portfolio and staying out of mutual fund? Is that correct?
Sir, it's true that there are a number of other ways to gain exposure to the market. Our data shows that within open-end mutual funds, when there is a market stress occasion, typically the first movers are the institutional investors in that space, and they would be then asking the fund to sell the most liquid assets at that point, which leaves
One could imagine a swing pricing rule that applied to transactions of over $10 million, and you'd face an awful lot less opposition than when you start imposing swing pricing on the people that we represent. Is there any study that would indicate, I would say the best way to get people to pay $100 to get on the lifeboat is to announce that that for the first time ever you're charging people to get on the lifeboat. That would get me on the lifeboat, right? Is there any analysis that says that swing pricing will stabilize the markets, or would it have the effect of anything, of saying, oh my God, now I got to sell?
It's an excellent question, Congressman, and the economic analysis with this rule does take into account the costs and the benefits in an attempt to balance those considerations, as you suggested.
My time has expired. Thank you.